All right, we started off the week in a typical Monday fashion, very low volume, very small range, but despite that, a pretty darn good rally. Up, I think, what, more than 1% on the S&P 500. Pretty good move to the upside. Again, we're breaking through like some moving averages here on the S&P. Really important that we get bigger ranges and bigger volumes when we break through so that we can sustain the breakthrough to the upside. So that wasn't quite what we got today. There's still a few red flags that may not necessarily point to the S&P failing here at the moving average, but more might be suggesting that the rally we get might not be nearly as strong as what we just saw coming off the Halloween low point of last year, where we rallied for like over 4 months to the upside and nearly 30%. So probably going to be less than that based off of the type of move. So again, I'll break down kind of the good of today and the bad of today, and what we need to kind of be aware of over the next few days to confirm our expectations that we are indeed starting a new bullish intermediate rally that ideally would last, at least a few more weeks, if not a month or two, up to the upside, with probably close to a double-digit return in that 10% range. So we'll break all that down, and today, kind of what's breaking today. Interesting move in commodity prices. We'll break that down, what that might suggest going forward from here. And we'll take a look, too, at the other two main drivers of price action here lately, which is the dollar index and the 10 yields, especially the 10-year yields. So we'll take a look at what they're doing, how that's impacting sector rotation, which is actually moving in a very favorable way right now. So we'll look at that. And then our trade ideas in our hot sector right now. And we'll talk about a bullish trade to take advantage. So let's go ahead and get started. Today is Monday, May the 6th, 2024. This is the Market Outlook from MarketScholars.com. My name is David Settle. Before we get going too far, I invite you to subscribe to our YouTube channel with this icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos, and join our Market Outlook Facebook group that we've created. Alright, if you're watching us on our blog, check out some of these other things over here on the right, including our Market Outlook live video. I take a look at all the old trades. We got out of a couple more today. We also put on today's trade idea already before the market closed here. Come down to the bottom, click this heart. It opens up this tab. Hit that like button there. Same thing here. Click this thumbs up icon. It opens up this tab. Hit that like button. Again, the more you do that, it helps get our content out to all of our followers on those platforms. That's why we always ask for it every day. So thank you to those who do that day after day. Those who don't, you can do right now while you're watching with 1 or 2 really easy clicks. And we can get our goal to up to 100 here on the Market Outlook tweet. All right, let's start off taking a look at the S&P 500 with the market forecast indicator. As you can see, we got our bear tag today on the S&P. Remember, I got the bear tag on everything else but the S&P on Friday. Finally got it on the S&P. The intermediate line's rising again up to its highest level since those clusters, since the low point. Not quite up in the upper half of the charts. That's why we don't have dark green shading. We are 1% above the moving average. You can see, for example, when we got to the green line over here, we were almost 2% up above. So we do need to get a little bit higher above the moving average, but still, this is pretty good. It's not the best range. It's a little bit more than half. It was a lot better than where we were at earlier in the days. You'll see when we look at the intraday chart. But still, again, it's not the greatest. It's not the way that we typically like to bust through these moving averages. You typically like to bust through these with good, strong ranges and a good, strong near-term line, and that is one, and well above the moving average. And that is one thing that we are getting today, at least. The near-term line is up to the 95th percentile, following the momentum line that got up to the 91st percentile yet on Friday. So that is a very good sign for the markets in terms of starting this new intermediate rally. Of course, again, we can't let it drop back down, but that's what, again, at least the likelihood of that happening is lower because of how high we've gotten here. Anything can happen, of course, but that's a good sign for the S&P. If you look at the Dow Jones Industrial Average, again, not as bullish, a much smaller range, so below the 50% of the average. The market sentiment line is almost in the lower half of the chart now. The intermediate line still below. The intermediate line still below market sentiment on the S&P as well. The green line is still below the orange line. It's closer to the orange line on the Dow, but both are still lower. So the lower market sentiment and the near-term line's not close yet, and we're only 0.75% above the moving average. Like I said, with a much smaller range. So, but the near-term line did get to extreme highs. It got above the 90th percentile without the momentum line, however. So that's not the best sign. You like to see the momentum line get you up there first. Didn't happen either one of these times. So a little bit of a soft red flag there, but nothing too major. Looking at the Nasdaq 100, looks just like the S&P, strongly at 1.5%. Strong near-term line, kept following a strong momentum line, so that's all really good. And then your Russell 2000 looks a little bit more like the Dow, right? But in this case, this is the only one where the intermediate line actually is outside of the bearish territory. Well, the S&P is too, but it's not. The Dow is not. Remember. But in this case, look how close we are to getting above market sentiment. So the Russell appears closer to starting a new intermediate run from that regard. We are also, further above the moving average than we are in the S&P, almost 2%. Momentum line got to extremes. The near-term line did not get to extremes. Momentum line got to extremes on Thursday. The near-term line followed, but did not get up there yesterday, and is still kind of hovering around there today, despite the drop in the momentum line. So good short-term sentiment. We got a continued good run. So we've had a 4-day rally right now on the Russell 2000, and we've had a pretty decent move here on the S&P 500. Remember how we started off with a relatively weak 10-day run going into Friday and yesterday, but now including today. This is a pretty good rally for an 11-day move coming off. Again, it's not, over here we had a 7, almost 8% rally coming off of there, and we're only at 4.25, but still 4.25 still is a pretty good. In fact, there's only been 2 other moves in the last year that have been stronger in 11 days than what we're seeing right now. And that was coming off of the convergence low point, and then coming off of this consolidation low point. So pretty good move from that perspective. Let's take a look at the weekly chart that we see. You can see again after this transition candle, we started off with a transition candle earlier today, but then turned really bullish. So that's a pretty good bullish candle because of the 1% rally. We have a pretty good reversal. So we had that transition. It was not that bullish. But now, the last part of the week and then today is bullish enough that we're kind of avoiding a new transition here this week so far, and most likely will. You can see the size of the candle is not the biggest, right? You'd like to see a little bit bigger when you're reversing a trend. For example, that was a pretty good size candle, up 3% down there at the bottom. If you look at some of these others, this was at 2.25%. So we're at 1 1/3. So because this was an intermediate pullback, so for a move that's bouncing up off an intermediate low point, it kind of harkens back to this. Well, even this was up 2.25%. And again, the week's not over, so we might still get to 2% if we have a good, strong week the rest of the week. But as of right now, it's not looking very strong on that bounce there. Let's take a look at the 3 green arrow chart. Obviously, you have 3 green arrows. We've had it on Friday. We're especially there now today. We're 3 green arrows across the board. So it's a good sign. Remember, the first red arrow, if we were going to get back to 3 reds, the first red arrow will most likely be the moving average. So the further away we can get from the moving average, and the more it turns green, the less likely we'll actually get a new set of 3 red arrows. And usually when you're in bearish trends and you get 3 greens, it's only 3 greens for a day or 2. So as of right now, so far so good. And barring a big move tomorrow or Wednesday, we most likely probably won't get 3 red arrows here. So it's a good sign that we followed up Friday's move with a pretty decent gain today, despite the small range and the extremely small range and the small volumes that we saw today. If you break those lines apart, you can see here the 8 and 17. The MACD has turned positive. Stochastics has gone into bullish territory. So those are both very good signs. Barely, but still, barely is better than nothing. So that's a good sign. We're above now the 30 and the 50-day moving average. Getting the 8 and 17 day above the 30 is kind of your next step, but also it happened to be above the 50 in that case. So all very good signs. Remember, the diamonds is the one that's a little bit weaker, but still it's above both its 30 and 50 day as well, with a strong MACD and stochastic, or at least with a bullish MACD and stochastics down there. Your DMI crossed, so your positive crossed above the negative, though barely above 25 on the positive, barely below 25 on the negative. So you kind of see, this is the opposite direction, but you can kind of see when they barely cross, it can be a reversal, right? And so I don't see, let me see if I can find another example in the bearish direction, because we've been bullish here for the last year or so. So you'd have to go back to, let's see here. I don't really see another good example of that. You can see plenty of bullish examples. Well, here's a bearish one here, and it was a little bit higher, but you got the crossover where we barely got below 25. In this case, you actually did get above 30, and then ended up being a failure. And so, so that's kind of what we need to avoid on this move. This can't be just a barely cross where we barely get above 25 on the positive and we barely get below 25 on the negative. We got to really continue this, and especially with the ADX already above 20, we can't have this be a failure and have these gaps fill in here. Looking at the RSI and the CCI, strong move on the CCI today, up almost to 200, so kind of confirming that bullishness. Almost above 60 here, so get another good day, and we can now turn this green. So that's a very good sign for the markets here. Looking at the Ichimoku cloud, we lost the bearish trend. We are above the cloud, barely. We have a negative rate of change, but we are above the cloud, and we lost the bearish trend. So that's a very good sign too, in terms of a new bullish trend developing. Looking at the Bollinger Bands and the Ichimoku cloud. So we already looked at the cloud. Looking at the Bollinger Bands and the Keltner channel, sorry. We are now in the upper quartile. We're not pushing up against the band, but at least we're in the upper quartile. And the bands themselves have moved inside the Keltner channel. So, push up against this upper band, and let's get these bands back outside the Keltner channels with some new green dots and bullish momentum, and away we go. Right away we go up to the upside. So that's a very positive development as well. Looking at today's range, higher high, higher low, another gap, right? I would not consider that necessarily a runaway gap. If you look at the daily gaps here, you're right here. It was a little bit above one standard deviation. It was Fridays is really the one that had the best opportunity for a runaway, though this was the more of a runaway pattern than what we saw on Friday. That was a little bit of a concern that we didn't have this kind of pattern on Friday. It would have been very ideal, but we might have actually done that here. So this might kind of be one big runaway gap when we're talking about Friday's gap, and we just continue to go into like another day on this. We did fill in a little bit of a gap, which is not the best sign for runaway, but again, the rest of this would look good. If this were a one-day pattern, that would look really good, relatively speaking. So Monday might have saved us from Friday not being a common gap and filling that in. So there is a concern though that today is a common gap too, which if we were to fill in both of these gaps, that's a pretty decent distance down. So that's kind of what we'd like to avoid. Obviously, we don't have a new breakout pattern, but we're set up for one. The new high is by the end of the week, the new high will be today's high by the end of the week here, because we'll get these days falling off. So this will be the new high of the week. Now the question is whether we get a new one later. But you would expect that we will, considering we're easily above last week's high point. Just need to avoid filling in either one of these two gaps by the end of the week as much as possible. Obviously, I alluded to the volume. The trading range is really, really small. Here, let's actually look at it here. This is the volume and the trading range. The trading range, again, below, almost below, right about average, or half, excuse me. But look at the volume, way low. So, again, even if you count for the gap, which was 511.29 to 513.30, so a 2-point gap, so you're at 5.3, you're still below the average, even with the gap, and you're well below. So again, not the best, you would like to really break through these moving averages here. You would like to really break through these moving averages with pretty decent volume and pretty decent range. So this range back here was 4.36 points, but when you add in the gap here, it was, let's see, 422.66 to 426.56. So you got about a 4-point move. So you got 8.36, which would have been well above average at the time. If you were to look at the ATR in 11.2, you'll see that. So in fact, let's look at it over here. Back on 11.2, you can see the ATR was 5.74 points, and we were at 8.36, well above the average. That's not the case this go around, right? We're below the average, and you can see the average there, even though it was lower on an absolute basis, was actually higher on a relative basis than it is now. So, you know, that doesn't, just because we're at a higher absolute level doesn't mean, oh, well, then now we don't have to have such a, no, you would like to have bigger than average volumes, bigger than average ranges, and both of those are really, really low. So again, a little bit of a red flag that we do need to pay attention to if we aren't able to get a new 52-week high by the end of this week, if we don't just keep busting through up to the upside. Again, I do believe that we are starting a new intermediate run. It probably won't be the best one. It won't be like this one here where we go up 27% in 4 months. It'll most likely be kind of like a 1 to 2 month kind of 7 to 10% rally is kind of what I'm guessing would be more likely scenario. Remember, we're already up. And that's not that much more. We're already up 4.3%. So probably another few percentage points from here is probably all we're going to be looking for on this particular intermediate run. And you can already see, you know, considering how much of a grind it currently is. And the other factor, too, that's really kind of limiting future returns is the fact that the VVIX, I mean, the VVIX is extreme. I mean, 80 is extreme. So the fact that we're at 73 is unbelievably extreme. It is, again, one of the lowest levels of the VVIX, which will pretty much reduce, you know, the size of the moves going forward from here. But if you look at the VVIX here at 73.46, like it's the lowest of the past year. So let's go 73.46 here. It's the lowest of the past year easily. We did get to close to it, 73.88 there in January of 2023 and again in March. And you can see kind of what happened to volatility after both those instances. Remember the VIX, you can see the VIX relative to the VIX 3M down here. Very, very extremely low. But then you go out to like, you know, some of these other instances where the VVIX got as low as we've gotten now. You know, the last time really that we were this low at 73.18 was May of 2015. And again, you can see what the VIX did. That was the lowest point. The VIX has rallied from there. So that is one limiting sign that we have right now. The VIX is at 13.5. It's not, I mean, again, if you look at like, last time we were at 13.5, right, where we were at 13 right here, the VIX down at the bottom was well below 90%. We're barely getting below 90% now. So, I mean, the VIX is really, really low. It's really low on its own absolute basis, well below these moving averages. It's really low compared to like with the VVIX, but it's not that low relative to the VIX 3M. So with the extremely low VVIX and how low and how not low we are on VIX versus VIX 3M, it suggests that we've really come down here, that we're most likely going to get a rebound in volatility, which would suggest a failure on this rally, that we're not going to start an intermediate run. So, and again, I believe we're going to have an intermediate run here. I don't think it's going to be that big. I think the VIX would have to stay low, but I am watching very closely what happens to this VVIX and what it does with how extremely low it is. Again, when you look at its correlation with the VIX, it's typically very highly correlated. And so if this were to bounce, which you assume it will, you would expect the VIX to bounce too. And considering it's not that low, it suggests maybe on an absolute basis it's gone a lot lower than it should have compared to what VIX 3M is doing right now. All right, now let's talk about what's driving this price action here today. And let's take a look at, again, it wasn't very much of a move today. After a really big week, a very eventful week last week, Not so eventful today, of course. That's not typically eventful on Mondays. But here's the day today. You can see IWM started the day strong with, relative weakness in bond yields. Bond yields ended the day down. They were kind of flat at the beginning of the day. But you can see kind of a big difference between real estate, though, and the Qs. Remember, the real estate's kind of been acting like a tech stock here lately, but that's not the case here today. And also, interestingly enough, you had a three-headed monster. The one head that's kind of distinguishing itself from the other two is commodities. Commodities had been a little weaker during this last pullback in the markets, really rebounding strongly today up to the upside. And U.S. equities in particular really don't care. International equities underperforming, especially emerging markets, after a really good week for emerging markets last week. So let's take a look at the yields and see what they've done here. Here's a 10-year yield. Remember, the 10-year yield has pulled back. It's sitting on a 30-day moving average. MACD and stochastics are down. So now it's a question of, are we going to bounce off this average or not, or continue to break through? The dollar kind of looks very similar. Kind of a little bit below the moving average, there, but still, you can see kind of on Fibonacci support, at least from a long-term basis. The big change, of course, is in commodities. Let's take a look at the commodity index, and you can see the rebound. It came down to the 50-day point of control in the past year, rebound in a big way. Not quite back above the 30-day moving average or above the 17-day quite yet. MACD and stochastics still below their moving averages, but you can see that's a pretty decent move. That's a pretty decent move there, and could have an impact. Again, like inflation expectations have been kind of coming down here because of this drop in April that we saw, especially in crude oil. Crude oil really had a pretty down April, where we peaked right here, looks like right here was where we peaked in March. And then, of course, by the end of April, here's the end of April right here. So not quite not that big of a move. We finished March at 83.11, finished April at 81.55. So that's kind of had a little bit of an impact on some inflation expectation, dropping back below the 200-day moving average. But again, up today, not as much as commodities as a whole, but up today here, and so. We'll see how that impacts things. Again, going into seasonally, still a bullish time of year for crude oil prices. Like when you look at crude oil seasonally, we don't generally get this big of a drop. So you kind of go sideways a little bit, but we tend to go right back up here until the end of June, and then a retest there at the end of July. So we'll kind of see how much of an impact that has. Of course, the 10-year yield, you can see, usually has one more little rally up before it hits the on average, the high of the year. So keep that in mind there about the 10-year before it tends to have a pretty decent drop down there. And then finally, your dollar index also tends to have a drop this time of year before rallying up, for the rest of May now. That could have an impact on risk appetite if we were to continue. Of course, some of the things we've been watching for here, let's take a look at a ratio chart here. This one, there's a couple of these that we've been watching the last few days. Getting back below these moving averages, the utilities relative to the U.S. is broken above the 200-day moving average. We want that to break back down. If you look at technology relative to the S&P 500, it had broken below its 200-day moving average. It's bounced back up, hasn't quite gotten back, a little bit above the 30, not quite back up above the 200-day moving average yet. Another one that we've looked at is discretionary versus consumer discretionary versus consumer staples. It had also broken below the 200. It's rebounded, but not quite above these moving averages quite yet either. And then finally, the Qs relative to IWM. Again, below, kind of sideways below the moving averages, still holding the 200. Remember, the 200 is the big break that we want to try to avoid, if at all possible, on this. If you look at like the breadth, if we look at the new highs and new lows, big move up today, up to 295 new highs. Again, that will be updated when the NASDAQ composite gets updated here later. That's a good sign. You can see also from the number of stocks above the 50-day moving average. We talked about this last week, that we kind of need to see this break out. When it breaks above the moving average, we kind of need to see it like a 40% move like we tend to get to really turn the trend around. Well, we got 15, and that's not, it's a good break above the moving average, but it's not the type of break that, where you can kind of see some of these others. We had that kind of a move up like this one, for example, as well, and it failed, right? So again, we kind of need to see a little bit something better than what we saw here today, and hopefully maybe tomorrow we might be able to build on this and really bust through that moving average. But as of right now, again, this would be another red flag in terms of this failing here. Another good sign from a Brett standpoint is that McClellan oscillator really breaking up to the upside here today, up to 65. Very good sign. So easily above 35 again. You can see the summation index moving higher again without breaking zero. Very, very good sign here. So that's a good sign. On the other hand, like we talked about, the volume, the money flow continues to be very, very light. So again, if I were to go back here to, let's see, we closed here at 516.78. So this is the last time we kind of close at our current levels. And again, the price is exactly the same as where we're at right now from that day. This would be March the 12th. So May the 6th, we are right smack dab at the same level. But the volume is nowhere near being back to the same level. Again, that's a huge red flag because that's on all other intermediate bounces. We tend to bounce right back up. So if I were to go back and just look at from the highest closing price, this is where the volume was in the highest closing price. We need to kind of get back to that level at least to try to get some kind of inkling. But even here, when you look at, we were at 518 there just recently. So if you just look at just the drop and bounce back higher, there's the volume there, and we're nowhere near that either. So we continue just to be very, very bearish on volume. So breadth looks good. It could be better, right? We could have really had a bust through on that number of stocks with the 50-day moving average. We really didn't. But the volume's really not supporting it either. So, ideally, again, by the end of the week, things change from that regard. And I think that we will still get a bullish intermediate trend. And a lot of these red flags may just be a sign. That we might be that like on what I'm saying, that this might not be that bullish of a move compared to the last bullish move where we got a lot of these really good signs and we busted through and had a good volume and good breadth and all of that, and we ended up with a really good run. We're not getting all of that. Probably won't get a really good run as a result. Let's take a look at how the sectors moved here today. So let's pull up. Let's pull up the sector comparison first. So we'll take a look at this, and then we'll bring up just today alone. So May the 6th. Technology, discretionary, communication services, all doing really well. Financials doing well. Industrials doing well. Energy even. Energy was actually really bullish for most of the day before pulling back here at the end of the day. Staples lagging. Real estate lagging, which has not been typical here lately. Utilities, healthcare, all lagging. So your safety trades lagging. Your bullish trades doing very well. In fact, if I were to zoom out to when we bottomed out here, so it would be, let's see here, it would be not the 3rd, but it would be the 19th where we bottomed out. So from that day going forward, we've been bullish, and it's been technology, discretionary, and utilities, which have been leading the way, ironically. Communication services have really been lagging. It's still lagging behind. Real estate has been up there too, along with these, but it's really lagged the last couple of days. And energy, of course, dropping behind as long as these other cyclical and safety sectors down here. But those two look great. I mean, that's who you want to lead. Utilities doesn't look so great, which, again, that's kind of why when you look at the rotation graph here, the utilities is just so far to the right in terms of relative strength. Though it is losing momentum, you can see utilities, healthcare, staples really losing momentum in a big way. In fact, probably the biggest momentum, along with financials, the biggest drops in momentum, and discretionary and technology kind of have the biggest gains in momentum right now. So we are shifting away from safety towards the cyclical areas, and that's a good sign, right? From a if we're looking at that what will start a trend, that's what you want to see, right? You don't want to see materials lead the way higher. You don't want to see utilities lead the way higher on a bullish trend. You want to see technology and discretionary, ideally communication services too, but at least it's gaining some momentum, even if it's still moving to the left in terms of relative strength there. All right, that brings us to our trade idea of the day. I want to take a look in that technology space in particular. We'll take a look at network appliance, NetApp. If I can not fat finger this, let's try this again. All right, there we go. Dark green shading. We got a bear tag on Friday. Follow through on that in a very good way, up almost 5% above the moving average. Dark green shading in a green line. Very, very good. Earnings coming up after May expiration. Intermediate line rising into the upper half of the chart. That's why I got the dark green shading. Strong momentum line. Extreme highs in the momentum line yesterday. Extreme highs in the near-term line today. Intermediate line is close to crossing above the rising market sentiment line. So very good from that perspective. Good bullish candle developing here on NetApp on the weekly chart. So that's a good sign, a good development there. If you look at the whole moving average, NetApp, you can see back above the 200-day hull here. And when you look at the weekly version, we are almost back above the 20-week hull, and we've been bullish, and that average remains green, so bullish too. So very, very good, strong trend we have right now. Obviously, you have 3 green arrows on the stock. 3 green arrows here. You have above average volume for 1.5 times the average volume for 2 straight days. So that's a very good sign. When you look at the 3 green arrows, you're above the moving averages. A little concerned about the margin of safety, but rebounding in a good way. New 52-week closing high. MACD and stochastics at very bullish levels. Now let's take a look at some of these other oscillators. You look at the DMI, and you got a bullish breakout pattern here. You're above 30 on the positive, below 20 on the negative. That's a very good sign. Looking at the RSI and the CCI, they are also both at bullish levels, well above 60 on the RSI and well above 200 or 150 and above 200 on the CCI. So that's a good sign. When you look at the Ichimoku cloud and the trend strength indicators down at the bottom, you can see they've gone back up to at least a week bullish trend. We are above the cloud, above both those lines. The green line's crossed above the blue line up there. Very, very good sign. And then finally, you're above both the Bollinger Bands and the Keltner channels today. So above the bands had come down a little bit above the Keltner channel, and the bands themselves have crossed back outside of the Keltner channel. So that's a good sign too for the market. So very good bullish breakout type move today on network appliance. So what I decided to do was sell that mid-30s delta, but buy, instead of doing a bear call spread, I'm going to do a bull call spread. Buy the one strike in the other direction, buy the 110. So now the stock has to get up to 115 and get almost a 2-to-1 reward to risk ratio. I got a lot of flexibility in terms of the timing of the trade before the max gain falls outside of a 1 standard deviation. And a pretty good reward for a small risk that we end up taking on this trade. All right, that is it for today. You've heard from me. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember, subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us at marketscholars.com for free. Follow and like us on Twitter and Facebook as well. Have a great rest of your Monday night, everybody, and we'll see you all tomorrow.